The way I think about like climate transition is this is a 10,000 year economic megatrend. It is the longest economic megatrend in human history. And the equation I use is pretty simple. You take useful energy and you turn it into useful materials. And the useful materials are calories, electron, energy density, molecules, and water. We'll get into, other useful materials like intelligence, I'm sure, with AI and other things. And so, we started with fire, then photosynthesis, and then fossil fuels. And then to me, whatever comes next after fossil fuels. That is how I define climate transition.
Welcome to Sustainability Leaders. I'm Michael Torrance, Chief Sustainability Officer at BMO. On this show, we will talk with leading sustainability practitioners from the corporate, investor, academic, and NGO communities to explore how this rapidly evolving field of sustainability is impacting global investment, business practices, and our world.
The views expressed here are those of the participants and not those of Bank of Montreal, its affiliates, or subsidiaries.
I'm Angela Adduci with the BMO Climate Institute, and today we'll be talking about climate and sustainability-focused investment. Our guest, Sanjeev Krishnan, is a managing partner and co-leader of S2G Investments. S2G is a multi-stage investment firm headquartered in Chicago, managing $2.5 billion in committed capital. S2G invests in companies in key transition sectors, including food and agriculture, energy, and oceans, with a focus on companies pursuing innovative market-based solutions that generate positive social, environmental, and financial returns. S2G has over 100 companies in its portfolio, with notable exits including Sweetgreen and Beyond Meat. Sanjeev is active in developing investment strategy as well as overseeing investments and portfolio management. Sanjeev, it's great to have you on the podcast.
Thanks for having me.
So I gave a brief overview of S2G, but could you provide a little bit of color around how S2G came to be, how the firm has evolved, and where you currently focus?
Yeah, when we started, it was sort of early days of a focus on impact investing. And our view is we really wanted to focus on systems thinking and systems investing, really allowing for second and third order trends and issues and consequences to drive first order investment strategy, first order portfolio construction, and impact. And then at the time, we saw the greatest market gap in food and agriculture. Even today, it dwarfs the investments going to the energy sector, transport sector, et cetera. So the last time that, that I think the food system has evolved is really post World War II. One, the consumer was voting with their pocketbook differently. So, millennials represent sort of the largest consuming class in US economic history, 80 million people. They're voting with their pocketbook very differently for various reasons. Two, the physics, chemistry, biology, and computation of food production and food consumption was fundamentally changing. You had the rise of social media. There was this notion that the phone eats first, and people were taking pictures on Instagram, and we're very much intentional about food choices and where food came from. And then third, as the demand side of food changed, the supply side was also changing. And so we had this notion of farm to fork or sold shelf. And we also want to be multi-stage, so seed stage, venture stage, growth stage, to allow to finance companies throughout the life cycle. Beyond growth, we now focus on structured finance, and we've done work in infrastructure and real assets as well.
This is really interesting. So 3 key sectors, food and ag, which you took us through that sort of thesis, that systems change thesis, but also energy and oceans. So could you touch briefly on what you're seeing or what your investment theses are around systems change for energy as well as for oceans?
So the way I think about like climate transition is this is a 10,000 year economic megatrend. It is the longest economic megatrend in human history. And the equation I use is pretty simple. You take useful energy and you turn it into useful materials. And the useful materials are calories, electron, energy density, molecules, and water. We'll get into, other useful materials like intelligence, I'm sure, with AI and other things. And so, we started with fire, then photosynthesis, and then fossil fuels. And then to me, whatever comes next after fossil fuels. That is how I define sort of climate transition. We're rooting in sort of 5 things that we think are going to change capitalism, capital markets, asset allocation, alternatives, and including private equity and venture capital. And these 5 transitions we believe that are occurring is CPU to GPU, so shorthand for AI, unipolarity, multipolarity, shorthand for changing geopolitics, a declining price of money to an unknown price of money, so monetary and other cost of capital drivers. 4 is 1.5 degree heating to 2.5 degree heating or higher. And from a demographic dividend to a demographic headwind, i.e., aging. These 5 things in and of themselves are dramatic, but the cocktail of these 5 are going to have implications to the broader economy, but they're going to change the energy economy, the food economy, and the ocean economy.
When you zoom in then on these individual investments that you're making, there's a lot of really incredible technological advancement that's happening, I would say, especially in the sectors where you focus. And I imagine it can be tough to determine which opportunities are best suited for commercialization. So I'm curious to hear what signals you look for that tell you an opportunity is ready to scale and best suited for your investment.
So right now, our focus is on growth capital and then structured finance. So we're focused on the last 4 or 5 years on this notion of missing middle. And so there's many different kinds of missing middles. The most sort of popular is first of a kind facilities. That is not our focus. The missing middle that we're focused on is it's graduated from venture capital, but it's not yet ready for middle market private equity, or the owners don't yet want to sell to middle market private equity. And so that's the zip code of companies that are like above 10 million revenue, close to 20, 30, 40 million of revenue, perhaps, or EBITDA positive, or need the last financing before being EBITDA positive and cash flow positive is our focus. It's where we're investing at the moment on our equity side. And then on our structured finance side, we're focused on companies that need sort of financing to take maybe a CapEx sale and make it an OpEx sale, so hardware leasing, or they need distributed asset finance to fund, contracts, and they need this. They're not infrastructure sizing yet, but they're not senior debt yet. And so we're really focusing on this niche of missing middle, both on the equity side and on the structured finance side.
Yeah, that's a really interesting way to define the missing middle. I think we hear it more commonly in the context of first of a kind commercial facilities, but interesting to hear the way that you're thinking about it and the opportunity that you see there. One thing I find really interesting about S2G is the financing flexibility that you bring to the table when looking at these opportunities, as well as the overall markets that they play in. So S2G can provide debt, equity, hybrid structures, project finance to existing companies, but you can also launch new companies and joint ventures where you as a firm are seeing gaps in the market. And I'm curious to hear a little bit more about how you decide where in the capital stack to approach investment or market opportunities.
We're kind of obsessed, or I'm probably obsessed with what I call fit for purpose capital. So it's really originating and underwriting the idea from the real economy as opposed to an asset allocation approach. Both are valid, but to me, we really, in this 10,000 year economic and thermodynamic equation, we really need to look at fit for purpose. And what I mean by that is we think of this as a productivity opportunity and revolution. If you look at the last 4 big jumps in productivity that occurred in the last 300 years, you had railroads, electricity, oil and polymers, and computing. In each of the 4, you had innovation. So the Bessemer steel process and the steam engine, or Tesla, Westinghouse, and Edison, or Fairchild Semiconductor. You then had business model innovation. So when railroads went from local to regional, they started to have positive unit economics and made money. And then you had civil society or policy buy-in, TBD, if we have that in the US or not. And then the 4th thing, though, is each of those 4 had some sort of fit for purpose capital. To fund the railroads, you had the bond market's growth 6x. To fund computing, venture capital went from an artisanal to an institutional asset class. It is my hypothesis and belief that we do not have fit for purpose. We're jerry-rigging existing benchmarks, existing asset class definitions to finance the real economy of electrons, to finance the real economy of calories, to finance the real economy of energy density and water and molecules. And that tends to lead to suboptimal outcomes for everybody involved. And so what we really get excited about is, okay, let's understand the real economy. Let's understand how we generate alpha with said market gap or problem. And then let's go stand up either a manager or a platform to go do it. It is rare that we do that. Most of our time and attention is to focus on growth equity and on structured finance, to be very clear. But once in a while, we're able to, through our platform, identify market gaps and dislocations that occur and then stand up a strategy or a platform. The last time, maybe not the last time we did it, but an important time we did that was Clear Frontier, our farmland platform. So through our corporate partners, we worked with one of the corporates, as you know. These corporate partners, particularly in the food side, we're buying these companies at software multiples, but the supply chain isn't scaling. And a lot of them were organic or regenerative, platforms. A lot of them were being imported from other jurisdictions, and the integrity and cost were an issue. So they almost gave us a one-way exclusive. And so we started a farmland platform called Clear Frontier. We buy commodity farmland, convert it to organic farmland, and with the view of getting a higher cap rate than conventional farmland. And so we got the market signal from our corporate partners that this needs to exist. They gave us significant market signals. We knew from our growth equity work that you could do sort of 21st century organic economy and actually make more or parity yield for the most part. And then we found a team from an existing platform and recruited them and brought the capital. And Clear Frontier has done a phenomenal job. I think they own over 25,000 acres and are doing a great job of creating both alpha in terms of returns. But instead of a 1-year cash lease, they do a multi-year rev share, which is fit for purpose if you're trying to convert land use to organic agronomy, convert farmers through that process to do that.
You spoke about climate as an economic megatrend. Your thoughts on this are very interesting. One thing that I like to talk a lot about with people in the industry is that we hear a lot about the risks associated with climate change, and we hear less about the opportunities for innovation. And just broadly, I'm really curious to hear, you've talked about how you see climate. Do you have any reflections you'd like to share around climate sustainability quite broadly as investable themes that can be accretive?
Yeah, I mean, again, I think of climate investing as taking useful energy and turning it into useful materials. And I'm going to sound incredibly cliched. The useful energy to useful materials, suddenly people are talking about the useful material not just being power and electrons, but those electrons are going to basically be the feedstock of compute. And compute is going to be the feedstock of the future economy. And we have effectively, as a world, running a huge experiment at the moment with trillions being allocated or committed. And it's really this notion of global GDP is 100 trillion, software is call it 3 trillion, soft services is call it 20 to 30 trillion. And what the world wants is to buy chips, power with electrons, and those chips automate workflows of the service economy. And therefore, I don't think it's going to be general purpose intelligence, but certainly task intelligence is going to be the useful material for a whole rate of service industries that will have labor substitution powered by compute, which is ultimately powered by electrons. Beyond that, I think there are huge opportunities in autonomy and physical AI, robotics, autonomous vehicles, digitizing the physical world to make better decisions on farm, on aquaculture, on grid, on everything. And so I think that is a very compelling opportunity also. So I think this CPU to GPU has enormous sort of implications. As you think about multipolarity, as you think about debt and deficits and monetary policy implications, as you think about aging, the other big vector that I see is food system and healthcare changing. We're going to run out of money for Social Security sometime in the early 2030s. We're already spending 20% of GDP on healthcare. And I think there's an opportunity for the food system to lower the cost of the healthcare burden. You can pick your buzzword, but how does nutrition and food become a standard of care and not just drugs? And I think you're going to see that as a big economic opportunity. I think the other one is adaptation. And so there's going to be important companies providing the food system, the ocean system, energy system with both mitigation solutions, but also adaptation solutions so that it can grow food in droughts. It can understand weather prediction with ocean intelligence. And I think that those are important sort of vectors. And then each of those have downstream implications. Like if you believe a world of autonomy and robotics, you're going to need a ton of critical minerals and different manufacturing modalities. Yeah, I've never been more compelled by this equation of useful energy to useful materials.
Yeah, that's really interesting. So then circling back to this idea, you said you can't cut and paste lessons from, one area or sector to another. How do you decide where you can take lessons learned from other sectors, other areas, other times in history where we've seen, technological booms and huge shifts and changes? How do you decide what lessons you can take from that and where you need to maybe come in with a clean slate?
I think at the end of the day, what I view in a sober way is like these are commodity linked. The margin profile is not historic SaaS margins. It's not historic pharma margins or meta margins or Google margins. These are asset intensive for the most part. They're regulatory sensitive. They're oligopolistic for the most part. They're highly consolidated industries. So we start with that like core underwriting of what we do. And that implies certain things. As an example, it implies that it's hard to find terminal value buyers for these things. Most of the M&A that happens are present value buyers. So that's why in our growth work, we want to finance companies that are EBITDA positive or the last round before being EBITDA positive and really underwrite the exit to a multiple of EBITDA or a multiple of revenue, but linked to a margin structure that is comparable. We're not looking for a $10 billion exit based on some platform value IP. That makes no sense in what we do. And often private equity, particularly middle market and upper middle market private equity, underwrites the present value of cash flows, not discounted value of cash flows. Now, strategics could potentially do that, but we want to have multiple buyers to our companies. So that's sort of one way we've looked at this. In our sort of legacy seed venture work, not growth equity, I believe the power law is large ownership and getting companies EBITDA positive. That requires more of an evergreen liquidity cycle where you can be greedy when others are fearful, acquire large ownership positions in companies that you credibly believe will get to EBITDA break even, cash break even. And then you can transition a non-money call option to a put option. The power law there is you own 30, 40, 50% of business. It gets to 20, 30, 40 million of EBITDA.
This has been a very system level conversation, which is not surprising given S2G's approach to investing in your philosophy. And you mentioned a few individual businesses that you're looking at. Are there any other examples of innovative or exciting technology that you're seeing emerge? And what are the tailwinds or market enablers behind those?
I mean, one of the big things that I think gets underreported, quite frankly, is I think there's a broad consensus now around the electrification sort of thesis, particularly around power and data centers. It's almost cliched. One of the things that I'm most excited about, though, is physical AI, and that's robotics and autonomy. And again, if you go with cheaper, faster, better, no matter what, I think what's the Overton window on autonomy, I think, has been reached. I think if you go to San Francisco and drive a Waymo, you believe that there will be like driverless cars. If you believe there'll be driverless cars and autonomy, whether it's short haul or long haul, by the way, like we've done the math. those things are best done in the electric vehicle setting. And I think autonomy and fleets and electric cars are going to be just part of the future. And then you go into what supply chains or financing vehicles can we start to finance this secular theme of physical AI and autonomy. And that's going to have huge implications for fleets and electric vehicle mobility overall. Obviously, China is sort of leading the way here globally, but I think it's going to be also prevalent in Northern Europe and in the US. The headline issue is obviously been documented, particularly the last 18 months. But I think it's a fait accompli that mobility will be increasingly autonomous, and autonomous means electric vehicles. And there's many ways to get exposure to that trend, I think. And we're doing a lot of that work right now.
That's really interesting. And last time I was in San Francisco, I totally agree. I was like, this is here, it's happening. So very interesting to hear how you're thinking about electrification alongside physical AI and how that all fits together. This has been a really fascinating conversation. I feel like I've learned so much. Is there anything else you'd like to share before we wrap up?
I think we really need to reframe this as useful energy to useful materials. And we've been doing it for 10,000 years as humans, and we'll be doing it for hopefully another 10,000 years or longer. And this is not something that is doom and gloom, or it's not a hoax. It's just a thing we've been doing, and we'll be doing it forever. And so I really want to make sure we tell that narrative in that clinical way, and really thankful for you all to providing us and me an opportunity to showcase some of the real life examples of that.
Awesome. Well, thanks so much for joining us today.
Thank you for having me.
Thanks for listening to Sustainability Leaders. This podcast is presented by BMO. You can find our show on Apple Podcasts, Spotify, or your favorite podcast player. Press the follow button if you want to get notified when new episodes are published. We value your input, so please leave a rating, review, and any feedback that you might have, or visit us at bmo.com/sustainability leaders. Our show and resources are produced with support from BMO's marketing team and Puddle Creative. Until next time, thanks for listening, and have a great week.
For BMO disclosures, please visit bmocm.com/podcast/disclaimer.